We think investors should be aware of the fact that asset values are elevated right around the world. Starting with global bond yields, we see developed market bonds trading at levels that were last seen centuries ago, and equity valuations are generally high, particularly in a market like the US, where we see an index like the Standard & Poor's trading at 15-year highs from a valuation perspective. The obvious conclusion for investors is they need to be expecting lower returns from these levels, and hence risks of investing in these highly priced securities is higher than most investors are perceiving. On the other side of the fence, we think there are very good opportunities within the South African stock market. And that is because the South African stock market and elements of it are characterized by high levels of fear with respect to the South African political situation. And as a result, we see stock prices and valuations that are significantly lower. In an environment when sentiment is as poor as it currently is in South Africa, we found that mispricings tend to occur. And we think that is definitely the case at present. We think there's an opportunity to buy domestically focused South African companies at valuation levels that we last saw in times of significant crisis. We think this opportunity to buy very good businesses at low valuation levels on low levels of earnings bodes very well for long-term returns for our investors and for people that are exposed to these pockets of fear. As far as the risks are concerned, off of these valuation levels, we think investors should be preparing themselves for significantly lower future returns from most asset classes, and hence be trading cautiously. But the situation I described, where the significant fear exists with respect to the South African economy and parts of the South African stock market, is one which is likely to give rise to mispricings and hence give rise to good investment opportunities for long-term investors in South African equities, and we believe this is the case. We described a scenario of elevated valuations across the board. We think this is an environment which warrants caution, and hence cash levels across all of our multi-asset funds are high. The PSG Flexible Fund sits with more than 27% of its asset value in cash, and we sit patiently and wait for opportunities to employ that cash. As described, we've been finding fewer opportunities within equity markets, and that's particularly the case globally. As a result, we've been reducing some of our global equity exposure. We currently sit with 21% of the fund directly exposed to global equities, and in recent times, we've been sellers of US equities. We continue to look for opportunities, but we find globally that relatively elevated stock markets are providing few. We're looking where there are pockets of fear, and here I will specifically reference the impact of Brexit on the UK stock market we think is giving rise to some interesting ideas, and similarly the fear around the impact Amazon is having on global retail is also giving rise to some stock-specific opportunities. On the domestic front, we're quite excited. We're seeing opportunity to buy higher quality businesses that are deeply out of favor, mainly because they're heavily exposed to the South African economy. There we're finding very low valuation levels. In fact, the valuation levels are at the same kinds of levels we saw during the global financial crisis. But importantly, earnings levels are also low. And we think that opportunity to buy good businesses on low PEs, on low earnings, should bode very well for long-term client returns.